Welcome to Shared Lunch, brought to you by Sharesies. I'm Brooke Roberts, one of the co-founders and co-CEOs at Sharesies. In today's episode, I'll be speaking to one of the big bosses of one of the big four banks, ANZ Group CEO Shayne Elliott. We'll cover the bank's full-year results, the hot topic of competition, and where the sector is headed. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Hey Shayne, let's start with some of your background. You're a Kiwi, now in charge of one of the largest banks in Australasia. Has banking always been part of your DNA?
Oh, by accident, it has. I mean, it wasn't necessarily a plan when I left school and did uni, but after university, I literally fell into banking by accident. I responded to a advert in a newspaper to work at Citibank as a trainee. And so I've always liked sort of numbers and finance and things, but yes, and ever since then, I've sort of stuck it out.
And now you're the CEO of ANZ Group that spans across Australia and Aotearoa. How different does ANZ operate in those two markets?
Well, actually, first of all, we operate in 29 markets. So just to be clear,
true.
so we operate all around the world, and we've done so for a long time, actually. I mean, and just to give you a sense of history, we're almost 200 years old. We started here in Australia in 1828, and New Zealand in 1840, Fiji in 1880, Papua New Guinea in 1910, and then now we operate right across Asia Pacific, including all the big money centers, Tokyo, New York, Dubai, London, Hong Kong, etc., and right across the Pacific Islands. So 29 countries. But, our home, I guess it's what it says on the tin, right? ANZ, that's our home, Australia, New Zealand. We've been here a long time. We're big in both places. What's different? Lots and then not very much. I mean, at the end of the day, people want the same basic things, right? And certainly from an ANZ strategy point of view, people want help saving for finding, buying and owning a house, or starting, running and growing a small business. Or at the big end of town, if you're a really large company, you want help connecting with the rest of the world and moving goods, whether that's dairy products, iron ore, whatever it might be, and money around the world. And those are the three things we do. And that's what we help people on both sides of the Tasman do. So not really a lot of differences there. Obviously, regulations different, consumer preferences can be a little bit different, competition's different. But, at the fundamental, you'd say there's a lot of similarities.
First off, let's not ignore the ANZ full-year results. So revenue was similar to last year, down 2% to 20.55 billion, expenses up 4% to 10.55 billion, and cash profit down around 9.3% to 6.73 billion. There's a ton of change happening across banking, with open banking and more neobanks popping up. How is ANZ placed to keep its position and prosper?
Yeah, so when I started 9 years ago as CEO, we basically did a lot of sort of soul searching about what the environment we felt was going to be like, and how would you thrive as a large, comprehensive, pretty diversified organisation like ANZ, with 10 million customers across 29 markets. And what we found is, and I don't think this is rocket science, we said the world we live in, consumers want more. And consumers want more and they don't want to pay for it, right? And they're being trained, which is a good thing, to want 24/7 amazing services, always getting better, largely for free. So consumers want more. The community wants more. The community expects us to behave differently. It's not good enough community expectation just to say, well, those things are legal, therefore I do it. And so people have higher standards at a community about how we behave. Regulators want more, whether it's about more capital, more liquidity, better behavior, all of those things. And then lastly, competition was going to be more intense. I mean, we live in a world that is protected to some degree. We have a moat, using that sort of language, for good reasons, because, we as a community don't want just anybody running a bank, because these banks are looking after our deposits and we don't want it to fail. So there were reasonably high barriers to entry. You had to be big, you had to have a lot of capital, you had to be well run. Some of those barriers have actually come down a little bit for good reasons, to encourage more, you mentioned neobanks, but probably more importantly, more people doing payments. Think people like Revolut and Wiser and all, buy now, pay later and all these sorts of things. So way more competition. What do? Well, we said, we need to be more nimble. We, as a big organisation, have historically run ourselves on big fixed systems. We invest billions of dollars in big big computer systems, big branch networks, big things, but they're fixed and they're really, really efficient, but really hard to change. And so when competition comes out with something new or a regulator wants something new, those things were really difficult to change and we were slow. So we said, if we want to stay relevant, we need to be nimble. And so we set about basically changing the way we operate to be more agile and nimble. And that really comes down to 2.5 things. One thing is people. We need people who have a growth mindset, people who think differently, people who are excited about change, people who are courageous, people who know how to see something out in the market and say, hey, I know what that means for our business. So we call that growth mindset. And then we need our systems and processes that enable us to embed that change quickly, make that change, get that feature to market quickly, make that change from a regulation fast in a resilient, low-cost way. And the half bit was we need our people to be able to talk to our systems really well. So that was really, when we looked at what we had and where we started, we said, wow, you wouldn't want to be starting from here. So we've actually essentially re-platformed our bank, and we've now on this 2-platform business where we say we've got these 2 platforms, one for retail and small businesses and one for institutional big end of customers. And we're building a whole new banking system that is fast, reliable, safe, and really, really low cost. But from a shareholder's point of view, probably the 2 really important ones there, yes, low cost. It has to be low cost. We're in a commoditized industry. And the systems we can talk about it later, are dramatically lower cost than where we are today. But I think probably the most valuable point in terms of competitive differentiation is it needs to be fast. We need to be able to launch new features and functions quickly to stay ahead and satisfy customer needs.
I remember last time you were on Shared Lunch, we talked a bit about Suncorp and the acquisition there. That's one of the biggest banking acquisitions in a decade and just finalised in June after the Australian regulator, the ACCC, ran the ruler over the deal. Can we just remind listeners what the advantages this brings and also how you've addressed ACCC concerns about competition in the national home loan market, small to medium-sized business banking and agricultural banking services in Queensland?
At some level, our business is heavily commoditised, right? Our home loans do exactly the same as Westpac's. Our credit card does the same as ASB's. We live in a commoditised world. That's a good thing from a consumer point of view. It means, consumers get pretty good value. It's really, really hard to compete in that world. And in fact, going back to what I just said is we are very, very dependent on technology. Almost everything we do today, not quite, but everything is digitized. It's real time. At peak, on any day, per second, we have 200 customers checking their balance every second and making 300 payments. You need massive scale and technology, and all of it being done digitally. You need huge scale to be able to operate that kind of machine and that monster, right? But once you build that machine, if it's 200 customers looking every second on balance or it's 300, it doesn't really cost any more, or the marginal cost of that scale is much lower. So once you've got that agility and that scale, you want to be as big as you can because you can defray the cost over more customers. And it also means that the next time we want to launch a new feature, a new function, something really cool that customers want, it's cheaper if I can spread that cost over 7 million customers rather than 6 million. So what does Suncorp give us? It gave us more customers. Suncorp Bank, for those who know it, it's got about 2.5% market share. In Australia, we're about 13.5% share. It gives us scale. So we bring 1.2 million customers onto our systems. It just means that we will get significant economies of scale by having them on our platform. And from their point of view, we, without being arrogant, we have better systems and technology than Suncorp Bank because we're bigger. And therefore, we're able to bring the power of those systems and features and functionality to their 1.2 million customers. That's kind of it. ACCC, so that's the anti-competitive sort of regulator, make sure we're not doing any, we're not building monopolies and oligopolies and all that sort of stuff. Look, actually, what we said to them is, well, first of all, we're actually relatively modest today. We're 13.5% market share. Our biggest competitor in Australia, and again, remember, Suncorp Bank's only in Australia, and our biggest competitor here in Australia, CBA, they're twice our size. Twice. So they're at 26% share, I'm at 13, and after doing Suncorp, I go from 13 to 15. That is hardly reshaping the competitive landscape of banking in Australia. Oh, and Westpac is, 2/3 bigger than me. So we were able to show that even with this, we get bigger and get the benefits of scale, but it doesn't really change the needle. even in Queensland, where Suncorp is a little bit bigger in share, even in Queensland, it didn't really shift the needle on competition. And they're able to look at the public interest and say, hey, is there a broader public interest? So we made the argument that having bigger competitors, funny enough, is actually good for competition. That we're going to be more competitive with 15% share because we'll be able to do more tech spending and bring more benefits to customers than we are with 13. And, at the end of the day, while it was a long process, we got there.
Earlier this year in New Zealand, the Commerce Commission report into personal banking was released, citing that the big four banks, including ANZ, have a strong hold on the industry with little strategic differentiation and growth targets focused on maintaining market share and protecting margins and profitability. Also recently, ANZ New Zealand CEO Antonia defended the company's profitability in New Zealand. What do you believe are fair profits for banks to make? And how do you strike the right balance between delivering for customers and shareholders and wider stakeholders?
Sure. So probably unsurprisingly, I disagree with that assertion that it's not competitive. I mean, I've worked here for 15 years. I'm on the board in New Zealand. I know that Antonia and the team, just like we do up here, we wake up every morning paranoid. We wake up paranoid about somebody's going to come and try and steal our business, going to take our customers. Somebody might have a better mousetrap out there. And we have to be on our front foot, investing heavily to delight and retain customers. And that's what we do. So it certainly doesn't feel like that from the inside, that assertion that people make from the outside. Hey, what's fair? I obviously agree with Antonia's articulation of the issue. New Zealand in particular, but Australia too, we rely on foreign capital. There are no home loans or small business loans in New Zealand without foreign capital investing in New Zealand. We don't pay our way. That is just the reality. Now, that's okay because we're still a developing country in many ways. We have a massive appetite for capital to invest and grow and build a better future for ourselves and future generations. That's not necessarily a bad thing, but we need to, in order to attract that capital, we need to generate a fair return. What's a fair return? Well, the sort of techie answer to that is cost of capital. There's two costs when you're a business. There's the cost of operations, and clearly we cover that. You mentioned before, we make about 21 billion in revenue. This is at the group, 21 billion in revenue. We spend about 10.5, 11 running the place. So clearly there's a profit there. And then some of that's to cover credit costs. So that's the first tick. We do that. The second one, though, is we need to cover the cost of capital. We've got $70 billion of shareholders' capital. That capital comes from all over the world. Yeah, about almost 30% of it comes from outside Australia and New Zealand, and the rest comes here. People give us their capital because they expect a fair return on it. Not just the dividends, but they want to see the share price growth as well. And as a rule of thumb, and there's a complex way of figuring this out, but cost of capital for somebody like us is about 10-ish%. So it basically says, hey, if we want to continue to be able to attract capital without which we don't survive, we need to be able to generate a return of about 10% return on that equity to keep that money and shareholders happy and keep the investments coming so that we can continue to lend in home loans and small businesses and do all the things we do. And guess what? That's kind of where we are. In fact, at a group level, our ROE the result we just had was only 9.7, so we're not even quite there. And New Zealand's about the same, a little bit higher. So that seems about fair and reasonable. If we want a well-developed banking system that's safe and continuing to invest in the future. Now, if you don't get that cost of capital, and by the way, it's not a theory, you can go and have a look in Europe where they don't generate cost of capital. And what do you end up? You end up with banks going backwards in terms of actually not being able to support growth and not being able to invest in the future. And that's a really, really bad, as they say, there's only one thing worse than a profitable bank, and that's an unprofitable bank. Yeah, because then the whole economy you really end up in dire straits. And so I think it's about balance and pretty much where it is today.
You mentioned at a conference earlier this year around how in Australia we don't bank the middle anymore. Could you elaborate on what that meant, and does that ring true in New Zealand also?
A long time ago, and again, I'm exaggerating to make a point here, but just, a long time ago, and many of your listeners here or viewers, if you wanted a homeowner, you want to start a business, you'd put on your best suit or your best outfit. You'd go down to the bank, you'd meet the bank manager, you'd talk to them about what you wanted to do, and they would probably look you up and down, ask you a few questions, and they'd judge you on character and all sorts of things, including the numbers, and they'd make an assessment, right? and they back people with initiative and good ideas and those sorts of things who wanted to have a go. Today, for a whole bunch of good reasons, the system's moved on and regulation has said, well, we don't like that. We want you to be safer in your choices. We want you to have more robust analysis to back up any decision that you make. Spreadsheets, credit ratings, track records, all of those things. That's great. That's fine. And those are sensible things. Over time, those have become more and more and more complicated, trying to protect, so well-intended, trying to ensure that nothing ever goes wrong, so nobody ever gets hurt. We don't like it when people lose their house or when their business fails. So the way to do that is make it as hard as possible to get the loan in the first place. I'm not saying that that was the design principle, but that's what's happened. And so now we have to go through a lot of process, which is all good. But what it means is the people that would have had a chance in the past are missing out. And so we can see the data. Yeah, it's not just me theorizing here. If you look at people who have a home loan today, and you look at their level of income relative to the average person in Australia or New Zealand, it wouldn't be surprising that over time they've always been a little bit wealthier. They've always had higher incomes than the average. That kind of makes sense. That gap, though, how much higher than the average, has exploded over the last 10 or 15 years. Yeah? So now to have a home loan, you need not just 5-10% more than the average, and I don't know the numbers in New Zealand, but they're rough, in Australia, it's like 40% higher than the average. Used to be 10, 15, now it's 40. Why? Well, it's because we build all these safety factors in. Now, some people say, oh, that's because house prices are really high. Yeah, perhaps there's an element of that in there, but the real issue is that banks, it's been harder and harder. I'm not the only one saying it. My peers have said it's harder to get a credit card in Australia and New Zealand today than it has been in 30 years. In fact, getting a credit card is harder in Australia and New Zealand than almost anywhere else in the world. Because as a community, we've decided we're voting for safety. And so we don't and that's fine. It just comes at a cost. And the cost is people in the middle, that person that we would have given a home loan to or a credit card or a small business loan to 10 years ago isn't getting it today. And that's a cost. I think that's a real cost. It's a cost to aspiration and growth and dynamism in the economy. And so we raise it because we're worried. Does it affect the bank? Not really. Makes us safer, actually. I'm not proposing a change because of it's an ANZ's benefit. We're trying to make a contribution to the social structure and the economy to say, is this what we signed up for? Is this what we all agreed as a community? Is that the outcome that we wanted?
Actually, from what I see in New Zealand and in Australia, we're really good at paying our debt, paying our mortgage, paying our rent, if it might be. That is kind of ingrained in our culture or the way that we think about money. So how do you go about driving that change so that more people do have the chance to give it a go if, the numbers don't stack up on day one, but they've got the ambition, the appetite and the ability to make it work in the long run?
Well, we're not allowed to, and that's the point we're trying to make as the bank. And again,
So the LVR limits, as an example, and
again, so what's happened since the GFC? Largely, in the GFC, terrible things happened. Nobody's debating that. Largely, it didn't really happen too badly in Australia and New Zealand, but happened really badly in Europe, and we know, and that was awful, right? And as a reaction to that, governments, regulators, communities said, "Oh, we don't want that to happen again." Right? Absolutely. So we put in place all these new rules, all these speed bumps, all these controls, all well-meaning, and they grew up over a whole period of time. And what's happened, it's not like somebody sat around and just, wanted this, but what's happened is the people who are paying the price of all of that are the people in the middle. The people who would have got a home loan or a credit card or a small business loan then, who can't get one now, who are perfectly decent, hardworking, honest, well-intended people. Because we've said, we want to build all these buffers in, loan to value buffers, interest rate buffers, we have all these things we need to do. And again, they're well-meaning and they protect the bank. So, again, it protects us, and it should be no surprise that the credit losses in the banks are kind of at all-time lows. We've never lost so little, right? So that's a good thing. It means less people are, getting into trouble with their home. But my point is, but less people are having a home loan in the first place as a result. So the people in the middle. So the average Australian and the average New Zealander cannot afford the average Australian and the average New Zealand home, right? So I'll give you an example. It'd be like if we sat around as a community and said, we really don't want anybody to get hurt on the roads. I mean, we would all agree with that, right? So why don't we all just drive at 5 kilometres an hour? Well, we'd definitely stop road accidents, but the entire economy would grind to a halt. And it's kind of what we're doing in banking. We say we don't want anybody to get into trouble with a loan. That's fine. But the result of that is we lose dynamism. You know, I go back and I look at a lot of our customers who are now older, who started businesses, little businesses, startups. They were startups who are big, famous business people in Australia and New Zealand today. You go back and ask them how they started. How they started, they literally walked into the bank, put on their best suit, had a big idea, went, and they got to go because the bank backed them in terms of that aspiration and gave them a start. That would not happen today. It can't happen today because we don't allow it to happen today. We say, oh no, if you're a small business and you want a loan, you have to show me your track record. You have to prove to me you can repay in all these circumstances going forward.
Obviously, there's this movement with open banking. It seems to be a lot more advanced in Australia than where it is here in New Zealand. And we notice that with Sharesies, we can offer roundups and quick, deposits in Australia, but not here yet. And so let's kind of turn our minds to open banking and neobanking. We've seen success in the UK and Australia where customers are able to more easily switch banks or be offered more competitive services and products from third-party financial companies. But how has ANZ approached adopting open banking and tech in Australia? And will you be taking the same approach here in New Zealand?
So actually the neobanking thing has largely been a failure, and I think we should just call it as it is. I mean, most of the neobanks who started here in Australia have subsequently closed or been acquired, yeah? And the reason for that, and again, I'm being overly critical probably and overly a bit unfair, is because there was nothing neo about what they were offering was to a customer. There was nothing new. They still took deposits and made loans. And, the app was a bit sexier and, there was some nice features around it, but the fundamental proposition was the same, right? In fact, you could argue it was worse because they didn't have the breadth of services a big bank had, and really importantly, they didn't have the stability that a big bank has, yeah, in terms of the credit quality and the diversification benefits that we had. So, that doesn't mean we should ignore technology, but where the really profound change hasn't been neo-banking per se, has been real innovation, which is truly new propositions. So whether it's a Revolut or Wise or the way that, or buy now, pay later and those sorts of things. So different ways of engaging with your financials, right? Those are really where the innovation has come. Now, the challenges on a big bank is how do you engineer yourself to have the best of both? Big, stable, diverse, and innovative, fast, clever propositions. Well, that's our strategy. That's why we've launched ANZ Plus, our new retail platform, which is we've got roundups too, but we're the only major bank who can do it because we've built ourselves on a modern contemporary stack. Now, everybody criticised us for doing it because it cost $1 gazillion, costs a lot of money to do. But once you get there, what we're seeing today is the advantage. And we're only 2 years in market. The cost to service a customer on Plus is 35% lower than it is in our traditional bank. Now, a year ago, it was 20% lower. So it's getting, the gap's widening. So that's our future. I think the future is all about how do we embrace new technology. So we use open banking and Plus. Using open banking, you can go in and you can import your balances and transactions to view them from 110 other banks in Australia, any of them, yeah, and see it all and see your consolidated financials. That's really, really cool. Now we're the only major bank that does that as well because we've invested in the technology stack that allows it. So look, banking has always been about people and tech. We don't really have anything else, right? And the technology, actually banks get a hard time, and I'll give a bit of a plug for banks. Big banks are actually pretty good at rolling out and commercializing technology. Think about these things. We were pretty good at commercializing mobile technology, which is only 15 years old and now is our number one channel for customers' engagement on here, a rich, engaging experience on this, So we're pretty good at taking technology. And of course, the next big thing in my mind is AI. And the big, that is going to revolutionize the way we service customers and the propositions we bring to market. But you need the right technology stack to build on to enable that to be something really compelling.
I read somewhere that about 7% of the ANZ code written last year was generated by AI. I think it's GitHub Copilot. Can you tell us a bit about how you envision AI technology changing the operational nature of ANZ and also the banking industry as a whole?
One of our customers who sadly passed away now, Mark Beeson, founder of the big number of the big shopping centres in over here. Mark, I went to see him a couple of years ago. He's 90, and I was asking about how he was another one of those migrants who came to Australia with nothing and ended up, has a billionaire family, has created an immense wealth and prosperity for thousands and thousands of Australians who work in their company, right, and really good people. He said to me, 1956, NCR, National Cash Register, remember cash registers? They took us on a trip to Boise, Idaho. And in 1956, we saw the future. We saw supermarkets and shopping centres. And we came back and that's what we did, right? Well, I've seen the future as well. Maybe it was obvious to everybody else. I spent a bit of time up in California recently, and the future is generative AI. And I know probably people are sick of hearing about it, and there's no doubt there's an element of overhype. That's true in any new technology. But I've seen that future, and the future is going to come in two ways. All of us, all of the banks, everybody will start using these co-pilots that are embedded in every single tech tool we have. Microsoft Outlook, it'll be in Salesforce, it'll be in every tech tool we have, your phone, and they'll be great and they'll make us all more efficient, just like email made us all more efficient. But the benefits of that won't differentiate you. They'll all get competed away for the benefit of customers, but you still have to do it. Great. But the real opportunity is how do you then take those AI tools and intelligent automation that comes with it, advanced analytics, and embed those in propositions. Yeah. So imagine if in ANZ Plus, you had a virtual personal banker who you can ask questions of. Am I going to be able to afford to go on holiday this year? Tell me where my money went last month. Talk to me about, am I saving enough for my retirement? All the banks will do the productivity stuff, contact centers, all that. Some who have the right tech platforms will be able to build better propositions. And that's obviously where we aspire to be in Australia and in New Zealand.
So, thinking about the year ahead, what excites you the most?
We've got a lot of work to do at ANZ, embedding and integrating the Suncorp 1.2 million customers. We've got ANZ Plus on market. We have about 850,000 customers already who've chosen to move to ANZ Plus already, which is a great achievement. And next year, we're actually going to start moving our existing customers. We've got 6 million customers in our ANZ Classic offering, and we need to move, this is in Australia, we need to move them across. That's going to take a couple of years, but we start next year. That's really exciting. And then, of course, what I just talked about. We've got our first AI virtual CFO tool being built in Palo Alto with a partner at the moment. Hope to be able to roll it out for small businesses in the middle of next year. Because our strategy is, look, we need to give our customers better tools. People want tools to manage their money, make their money go further, own their home faster, not slower. We want people to own their home faster. We want people to be able to save for their retirement better. And the way you do that is with better tools, the tools and the insights and the data. And we think the way that all come together in this AI world. And that's, that's really, really exciting.
We had a rugby game in the weekend. Given you're a Kiwi, but you've lived in Australia for a while, are you a Wallabies or an All Blacks supporter?
I find that question insulting, actually. I can't even imagine. I can't imagine rooting for the Wallabies. I'm a diehard All Blacks fan. I mean, I'm a total New Zealander. I don't have an Australian passport. I don't want one. I love Australia and they're lovely people and all that. But I'm a very passionate Kiwi. But I'm, big passionate All Black supporter.
Well, I love to wrap up with a really offending question. Hey, thanks so much, Shayne, for coming on Shared Lunch today. Really appreciate it.
Thank you.
And thanks everyone for tuning in. Be sure to watch Shared Lunch on YouTube or on your favourite podcast app. Have a great week.